All right. Hi, everyone. Welcome to today's webinar brought to you by IronFX. I will be starting in a few minutes. Today's session is going to be the live trading session, and we'll just kick things off in a couple of minutes. All right. All right. Hi, everyone. Okay, welcome to today's webinar series on live trading session brought to you by IronFX. I just want to make sure you guys can hear me and see me loud and clear, and see my presentation slides as well. You should be looking at the first page of the webinar series live trading session. All right, let's just wait for before we get things going. All right, okay. It's time to kick things off. Please take note of the please take note of the disclaimer and the risk warning that comes with trading CFDs. Right, so all products on Iron's FX are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. Right, and also do take note of disclaimer that the information in this webinar should not be considered as investment advice or an investment recommendation, but instead is just educational material only. All right, so my name is Ketan Ramachandra, and I'm an investment analyst here at Everest Fortune Group. So this webinar series is brought to you in a special partnership between IronFX and Everest Fortune Group, where we've been the finalists for Best FX and Equity Research for the following years, 2019, 2020, and 2021. All right, before we dive into the charts and trading view, let's just take a quick look at some of the key economic events that are coming up this week. And of course, we can't proceed without looking at what happened at yesterday's FOMC meeting, right? So yesterday's FOMC meeting was at 6 p.m. GMT time. The statement was released at 6 p.m. GMT time, followed by Chairman Jerome Powell's press conference at 6:30 p.m. GMT. And then we'll look at the upcoming Bank of England monetary policy meeting that's going to take place in about a couple of hours. And then we'll look at the unemployment claims that are coming up in the US later on today, followed by the much awaited, highly anticipated non-farm payrolls coming up tomorrow on the 3rd of November. All right, so looking at the Fed funds rate, so as widely expected, the Federal Reserve maintained their Fed funds rate at 5.5% for the second consecutive meeting in a row. As you can see, since March of 2022, they have aggressively hiked interest rates, and now they are beginning to keep rates elevated. They may not be cutting rates anytime soon, but they're definitely keeping it elevated while they assess the incoming data to see the impact of higher interest rates on the wider economy as well as the labor market. Right, so here's a brief summary of the statement and some of the key things to take note of. Okay, so as we all know, Federal Reserve. All right, hey Wayne, glad to see you have joined us. Just want to make sure you can hear me loud and clear and see my screen as well. We just started things off, so just before we dive into the live trading session, we're just going to look through some of the key economic events coming up this week before we proceed onto the charts. All right. So as I mentioned, we can't proceed without looking at what happened yesterday at the FOMC meeting that took place overnight, right? All right, yeah. So as widely expected, the Federal Reserve did keep their interest rates or the Fed funds rates on hold at 5.25, 5.5%. So we're looking at the upper band, which is 5.5%. They kept that on hold for the second consecutive meeting in November, and this is a 22-year high. Right. So some of the key points to take note of from the statement as well as the press conference was that policymakers emphasized that any additional policy tightening would consider the cumulative impact of previous interest rate hikes, the time lags associated with how monetary policy influences economic activity, inflation, and developments in both economic and financial markets. Right, so basically, they are employing a wait and see action, right? While they see how the current high rates are going to impact financial markets and the labor markets as well, because we all know there's a certain time lag associated with the impact by high interest rates. All right, yeah, sure, Wayne. We'll definitely come to that as well. We'll definitely be looking at how to look at what to look out for with regards to the non-farm payrolls and how it could impact gold, the dollar index as well. Indices would be probably mildly impacted as well, but definitely non-farm payrolls is going to have a massive impact on the value of the dollar index, gold, and of course then all the associated currency pairs, and of course gold prices. Right, and also, okay, so during the press conference, Chairman Jerome Powell also signaled that although the September dot plot was forecasting one more rate hike, this may not be accurate anymore, as this could well be setting the Fed on a path of keeping rates on hold rather than increasing it any longer. Right. He also stated that the FOMC had not discussed any rate cuts yet, while the primary focus remains on whether the central bank will need to implement additional rate hikes, as there's still a long way to go to getting back inflation down to the Fed's 2.0% target. All right, so moving on, we have the Bank of England coming up in a couple of hours. Their official bank rate currently sits at 5.25%. They too are widely expected to keep their bank rate on hold at 5.25%. This would mark the second time or the second meeting in a row where they've kept interest rates on hold. Similarly, like the Federal Reserve, the Bank of England too, are adopting a wait and see approach because of primarily because of the slowing down of economic growth in the second half of 2023, right? They already expected economic growth to be weak in the second half of 2023, but the actual data or the incoming data thus far points to economic growth being much weaker than originally expected, right? So although inflation is still relatively high in the UK, but it has been easing quite steadily, but because growth is weakening much more than expected, so they too are very likely to keep statement, as well as Governor Andrew Bailey's press conference turns out to be relatively neutral, we could see the pound sell off. So that means currency pairs like the pound dollar is likely to drop. Right. Okay, what's coming up later after the Bank of England's monetary policy meeting? We do have unemployment claims in the US. So unemployment claims are basically a measure of how many people are filing for such unemployment benefits. So if you have a number that is trending lower, that means, as what we've seen since middle of this year, over the last 8 weeks, do take note, unemployment claims come out on a weekly basis. So as we've seen over the last 8 to 10 weeks, unemployment claims have been trending lower. So this signals a robust labor market in the US. And not only have claims been trending lower, they have been coming in lower than the forecast as well. So when the claims number comes in lower than the forecast, this usually functions as a bullish catalyst. So for tonight's estimate, we have an estimate of 210,000 claims. So if the actual result comes in lower than 210,000, this data is likely to function as a bullish catalyst for the dollar index. So that means dollar index will rise and currency pairs such as the euro and the pound will fall. Similarly, if the data comes in higher than the forecast, which is what we saw last week, right? Last week we saw a jump in the number of claims, as well as the number of claims coming in higher than forecast. So this usually signals a bearish catalyst for the dollar index. So that means the value of the dollar index will fall and currency pairs like the pound and the euro will rise. So do take note of how to interpret this data, and usually it's a good idea to wait for the data to be released and then quickly assess the impact has had on the direction of the market, and you can probably trade the news after it's been released, because typically this news event does have sustained momentum for most parts of the trading evening. All right. Okay. NFPs, right? So much awaited NFPs tomorrow coming up. We will have the unemployment rate as non-farm payroll. So in September, we had a huge NFP number, 336,000. Whereas this month's, or rather for October's estimate, is coming in at 182,000. So a somewhat moderation of growth, monthly growth with regards to NFP. So similarly, if we get a reading that's higher than 182,000 and you see the unemployment rate remaining at 3.8% or coming in at lower than 3.8%, this is quite likely to function as a bullish catalyst for the dollar index. Similarly, if the data comes in lower than 182,000 and unemployment rate edges higher, perhaps at 3.9%, then this is very likely to function as a bearish catalyst for the non-farm payroll. So this is how we can interpret the data and put on our trades accordingly. I generally would not recommend to put on a trade just before the data comes on, because as we all know, non-farm payrolls are very high volatility event. It is quite likely your stop loss is not going to be wide enough to sustain or ride through that volatility, right? You're just going to be unnecessarily stopped out, which is just a pain, right? Not only do you, if you lost financially, it also impacts your trading psychology as well. So if you do intend to trade the non-farm payrolls, do not put on a position just before the news is released. Rather, wait for the news to be released, quickly assess the impact that it's going to have on the direction of the market, do your technical analysis, and then see how whether is price action conforming to the data that you have that has been released. Right. So if you look at it, in September, the jobs gain or non-farm payroll gain of 336,000 was much higher than the forecast of 170,000, almost double of what was originally forecasted. And for this month, for rather not for this month, but for October's data, we're looking at about 182,000. So we can see a slight moderation in growth. Don't expect NFP numbers to have such strong readings every month. This was probably a one-off. So let's see how this tomorrow's data prints tomorrow. Yeah, let's see how tomorrow's data prints. All right, okay. Now with that, let's move on to trading view. Right. Okay. So here I am on the chart for the dollar index. I'm on the 4-hour time frame. Right. So as we mentioned, because of the FOMC meeting yesterday, where the Federal Reserve kept interest rates on hold at 5.5%, but overall the statement and the press conference was somewhat dovish, or rather the market has interpreted the press conference and the statement as being a dovish, having a dovish outcome. That is why you see the dollar index or the US dollar being sold off very aggressively. So that, of course, causes the value of the dollar index to fall. Similarly, because of that, you're going to see currency pairs such as the euro, the pound, the Aussie, and Kiwi rise as well. All right. All right. So let's look at where the key support levels and resistance levels for the dollar index. Okay, so I'm on a 4-hour time frame. Right. So looking at this, if you have been shorting the dollar index, do take note 106 would be probably a good target to good level to target for your take profit zone, right? So why is that the case? Because we see price reacting of this level a couple of times, just as recently as 31st of August, right? Earlier this week, price bouncing off 105.95. So 106 does look like to be a pretty strong support zone. So if you have been shorting the dollar index, taking profit or booking profit at around the 106 level would be a very prudent approach to take. Similarly, back in mid-October, we see prices, the dollar index bouncing off this level a few times. Then, of course, back at the start of October, on 6th of October, as price corrected quite strongly, the dollar index bounced off this level to form a little retracement before proceeding to drop lower. So you can see how 106 has acted as a pretty decent support level in the past, and we expect this level to hold once more. Now, whether this holds momentarily or do we see a strong bounce like this, it waits to be seen. But just like to highlight that if you have been shorting the dollar index, do take note 106 would be a good level to target to exit the position. Right. Similarly to the a little bit lower to the downside, if we do look at where 105.38 is, we see price running into resistance on 14th September, finding support on 22nd of September, and then finding strong support once more on 24th of October. So you can see 3 times where price has reacted off this level quite significantly, and this gives us confidence that this overlap level is a significant level that we can use to identify as the second support for the dollar index. Right, if we zoom out a little bit, I'm just trying to see if we could use any potential Fibonacci retracements, right? You can see since mid-July, this has been a very significant move up in the value of the dollar index, right? So let's see if we can use any Fibonacci retracements. Okay, wait, hang on, just let me adjust this here. Right, we're going to pull up, oops, hang on. All right, so let's pull up all the fibs and see what we get. All right, we do see the 23% line up pretty well with where 105 used to be, but because price has already reacted off 23.6%, we cannot use 23.6% as a support level anymore. Because just to take note for Fibonacci, once price crosses through that level, whether it crosses over or underneath that retracement level is not going to be functioning as effectively as it did the first time round. So that's why we are not going to keep 23.6%. But I'd just like to highlight, look at where 38.2% Fibonacci retracement lies. This is another nice overlap level here. So should price continue to drop further, this level here at 104.40 is going to potentially act as a major support level as well, because we do see price running into resistance here on 25th of August, and then once price broke above it, finding decent support on 12th September as well. So this overlap level at 104.40 does look like a pretty significant overlap level that aligns very well with the 38.2% Fibonacci retracement. All right, so that's for something in the future to take note of. But for now, with price currently trading about 106.20, that's still quite a long way off. So because of that, let's just get rid of the fib levels and just concentrate on where price is currently trading right now. Right, okay, so similarly, now that we've seen where the downside support levels are, let's look at the resistance. So naturally, of course, with price running into resistance here on 26th of October, forming a pretty significant swing high resistance here. And once again, yesterday as well, running into resistance once more. So 106.88 is how we've identified the first resistance level for dollar index. Similarly, for the second resistance level, we have simply taken the swing high here on the 3rd of October, right? We can see price making a very significant swing high resistance here, right? We can see price making a very significant swing high resistance here. Similarly, we see price making another swing high resistance here as well. So this is the sort of price action that we like to see so that we are able to identify major resistance or swing high resistance and major swing low resistance. Like this is a very, if you look at this price action here that took place on 24th of October, this is a very significant swing bounce here. Right, so let's tidy up the charts. Right, in addition, we've also used the Fibonacci extension level. So for Fibonacci extension levels, we use the Fibonacci retracement tool. So we started this retracement from 19th of October going down to 24th of October. And we're using the extension levels. The extension levels that are common or more effective are the 127 and 161% Fibonacci extension level. Similarly, with price breaching briefly above 127%, we're not using 127% anymore, but we're just keeping 161. Right, so you can see here that this zone between the wick of this candle and 161% would be a major resistance zone for the dollar index. Right, okay, so with that, let's just transition over to gold, right? Wayne, you wanted to have a look at gold, right? So if, like I said, with non-farm payrolls, so if you do see non-farm payrolls coming in stronger than expected, we could quite likely see the dollar index push higher tomorrow. Now, based on the levels tomorrow, obviously the levels could change overnight. So I can't really tell you what would be the resistance and support levels for tomorrow. But as of now, these are the current levels. And if you have been shorting the dollar index, do take note. 106 would be a good zone to target to exit the position. Now, if you get unemployment claims, and we're talking about unemployment claims coming up tonight. So if unemployment claims come in higher than the forecast, now this is going to function as a bearish catalyst for the dollar index. So that means if we get an unemployment claims figure later today, that's going to be much higher than the forecast, we could likely see the dollar index break below 106. So do take note of that. Similarly, if we do get an unemployment claims number that's lower than the forecast, we could see the decline in the dollar index stall and perhaps even retrace higher. So do take note of how unemployment claims could impact the direction of the dollar index later today. Right, with that, let's move on to the euro. Right, so as we can see here, earlier this morning, we had identified the level at 61.8% as an intermediate resistance. Why is that the case? Back on earlier this week, price running into a little bit of resistance at around 1.0615, right? 1.0615. Price ran into a little bit of resistance earlier this week. And that is why we identified it as an intermediate resistance, because it's just a small level here. We don't see any significant swing high resistance or multiple overlaps. That is why we identified it as a intermediate resistance. But we can see price rising strongly towards the first resistance, which is at 1.0630. Right. For this case, actually, okay, hang on. For this case, I would actually use this swing high here, the body of this candle here, to identify my first resistance. This was previously a good resistance level to use, but because you can see price breaking through this level twice quite easily, I feel that this level is not going to offer much resistance now. But what could offer significant resistance would be this pullback resistance or the swing high resistance here. So you can see the magnitude of this move. It is quite big. That is why I feel that the first resistance should be at 1.0645. That's where the major resistance level for the euro is going to come in. Now that in the intermediate resistance level has been broken. So if you have been long the euro today, where you should be looking to book profits would be around the 1.0640 level, right? This is where you should be looking to target your exit. Right. Now, looking at the downside, the first support at 1.0582 is a pretty decent overlap support. Why is that the case? We see price when it fell, pulled back sharply, it found a little bit of support here before dropping lower. And then once it started to rise back up again, it ran into a little bit of resistance once more before finally breaking higher. So we do see a case for a pretty decent overlap level, which now could potentially function as overlap support should price continue to pull back. Okay, right. So similarly, yeah, so just like the euro, do take note 1.0640 would be a good zone to target to book your profits on the long side. Similarly, the unemployment claims could impact the direction of the euro as well. So if unemployment claims come in lower than the forecast, this is going to function as the bullish catalyst for the dollar index. So if it's bullish for the dollar index, it means the euro USD or the euro is likely to stall and perhaps even reverse. So do take note of that. Do take note of how unemployment claims will impact the euro as well. All right. Okay. And of course, if you look at the price level at 1.0680, we can see once again price making a very significant swing high resistance here, and that is why the second resistance has been identified at this level. And second support, we can see price making multiple bounces off this level. So you could say that this is a multi swing low support, and of course that is why we've identified it as the second support at 1.0527. All right, so that's what we've got for the euro. Okay, let's move on to the pound. Right, of course, we have to cover the pound today because we have the Bank of England announcing their monetary policy meeting today. So let's look at the calendar. I'm on GMT time, so that's UTC 0, right? Just to be clear. Right, UTC 0, GMT 0, that I'm on UTC time. So we've got at 12 p.m. GMT, the Bank of England releasing their monetary policy report and updating their official bank rate. So it's widely expected they're going to keep the bank rate at 5.25%. What's going to be important is the report itself, whether is it neutral, hawkish, or dovish, and also followed by Bank of England Governor Andrew Bailey. He'll be taking part in his press conference or delivering his press conference at 12:30 p.m. GMT. So similarly, if the report and the press conference is somewhat neutral, perhaps we could see this rise in the pound probably stall a little bit. However, if he's somewhat hawkish, right, then we could naturally see the pound rising stronger. And once again, if you have been long the pound today, taking profit around the 61.8% Fibonacci retracement level would be a good area to target, right? For all the long pound holders, position holders, targeting the zone at around the 61.8% would be a good level to exit your long position. So that's about at about 1.2213, right? Similarly, to the upside, the second resistance is at 1.2288. As you can see, price making a very significant swing high resistance here. So this is where the next resistance level would be. Similarly, to the downside, if we look, there is not much. Okay, I would probably use. Oh wait, hang on. Right, I think I would rename the first support as the second support here, and I would like to use this level here at 1.2119 as the first support. Why is that the case, right? We see price bouncing off this level on 31st of October, then finding decent support yesterday as well. Of course, we do see the long wicks peaking underneath this level, but generally you can see that this pullback support level at 1.2119 could offer a pretty decent support level for price. All right, and then of course, the second support at 1.2054 is this significant swing low bounce here that took place on in early October, 3rd of October, right? So this is a significant support level for the pound. Right, so that's what we have for the pound today. So do take note how the upcoming Bank of England monetary policy meeting could impact the direction of the pound, right? And especially the report itself or the statement and Governor Bailey's press conference. These two events are likely to cement the direction for the pound in less than 2 hours. I mean, it's going to be up in an hour and a half, right? Yep. So 12 p.m. GMT time, that's right. So in about an hour and a half is when we're going to see the Bank of England make its move. All right, okay. With that, let's look at all right, gold, right? Wayne, you wanted to have a look at gold, right? Let's move on to gold then. All right, okay. Right, so if we look at gold, spot gold prices, XAU, USD, right? So generally, gold and the US dollar have an inverse relationship. So that means if the value of the US dollar is falling, gold prices generally tend to rise. And if the value of the US dollar is rising, generally gold prices tend to fall. But we've seen that inverse correlation break down recently, partly due to the demand for safe haven assets, right? We all know that on over the weekend on 7th, 8th October, we had the beginning of the geopolitical conflict in the Middle East, and which sparked a demand for safe haven assets such as the US dollar, precious metals such as gold, and of course treasury bonds as well, or government bonds. So because of that, since early October, we've seen a relatively strong positive correlation between the value of the US dollar and gold prices. So if we look from 9th of October till 21st of October, right, generally you have seen that correlation sort of, oops, hang on, play out. So you can see 9 October went higher, but you can see that although gold prices are, sorry, dollar index, the value of dollar index has been sideways trading. It's not really been impacting the gold initially, right? Okay, so 9 October, both value of the dollar index and gold prices rose together, but you can see that correlation then start to fade. So let's see, I can do a correlation with the dollar index. Hang on. Let me get this. Wait. Right, so as you can see here, what I'm trying to show you is here the inverse correlation, right? So basically, as you can see, in July to August, right, as the value of the dollar index went up, gold prices fell. So this is what we mean by inverse correlation or negative correlation. So when the value of the dollar index goes higher, generally gold prices tend to fall. And when the right. So you can see this inverse correlation or negative correlation play out quite nicely. Where it actually started to break down was somewhere around here, right? Over here, not so much, but around mid-October, right? Where you can see the value of the dollar index rising and gold prices rising strongly together with it. Similarly here as well, gold prices, a value of the dollar index was rising, gold prices have risen as well. So you can see that there is a relatively strong positive correlation between there was a relatively strong positive correlation between gold and dollar index from 12th of October till 30th of October. But now as we come into November, it does seem like that positive correlation is starting to break down and we are starting to see the inverse correlation strengthen. So do take note of that. It's important to take note of correlations, because if you simply have strategies that rely purely on positive correlations or negative correlations, and if those correlations suddenly start to break down, then you could be falsely entering trades as well. All right. Okay, so let's get rid of this and now just focus on the technical levels for gold. All right. So since this week, gold has pretty much been ranging between 2006 and 1975. So you can see it's sort of been range bound trading. This obviously first resistance. All right, wait, sorry. I think I noticed that Zoom got rebooted as well. Can you still hear me and see my screen? Yeah. Yeah, for sure. All right, great, awesome. Okay, great. You can see me. Yeah, definitely we start on gold. We'll go. Okay, okay. All right, great, awesome. Okay, let's continue. Right. Okay, so back to gold. Right. So since this week, gold prices have ranged between 2006 and 1975, right? So basically, there's not been any real major catalyst to push gold prices in either direction so far. What could probably change it would be NFPs, right? If NFPs can't move it, then I don't know what will. Okay, so before we dive into how NFPs could impact gold, let's just look at where the current resistance and support levels are. So if we look at 2006, price running the resistance here on 28th of October, then again on 31st of October. So this is a pretty decent pullback resistance level. So that's how we've identified it as the first resistance. If we zoom back a little bit and look at where price was trading back in early May, we do see a case for a pretty decent overlap level, right? Price running into resistance here on 10th of May and finding a little bit of support here after making this peak here at 2078. So this is a pretty decent overlap level, which is why we've identified as the second resistance. And not only that, it also aligns very well with the 161.8% Fibonacci extension level. So we found this extension by using the retracement, right? So we started this retracement from this swing high here on 20th of September, going down to the swing low on 6th of October. We can see that the 161% Fibonacci extension aligns quite well with where the second resistance has been identified, right? So this gives us an additional factor that contributes to the significance of this zone. Right now, to the downside, if we zoom in a little bit, right, we can see this overlap level at 1977 being pretty significant, right? We can see price running into resistance here, failing to break out. And once it broke above it, it found support multiple times. And again on 1st November and yesterday as well. So you can see multiple instances where price has reacted off this level. And that is why we've identified it as a pretty significant overlap level that we're using as the first support, which is 1977.64. A little bit below is another pretty decent overlap level, right? We see price running into resistance here on 18th of October, pulling back towards this pullback support here. You can see how this swing high resistance in the past that acted as a support level. So that this creates another pretty decent overlap support level. And then as price retraced to this level, it bounced higher, right? So then, and then it broke above this level and then found support here on 23rd of October and found support again on 24th of October before bouncing higher. So you can see why 1962 is a pretty significant overlap level, and that's why we've identified as the second support. Now, should price continue to break through these levels, for example, then the next key support area for gold would be at this level here, which is 1947, right? Why is that the case, right? As I mentioned earlier, price making a very significant swing high here back on 21st of September, and when price broke above it, it found support again. So this level at 1947 is a very significant support level now. So you can see price running the resistance here on 30th of October, running the resistance again on 20th of September. Oh, sorry, not 31st of August. Apologies, running the resistance on 31st of August. Finding resistance again on 21st of September, and then finding support on 19th October. So you can see that this level here is actually a very significant overlap level where price could once again find support should the first and second support levels be broken. Right. Okay. With that said, now how would NFPs impact gold prices? Right. Okay. So as we mentioned, right, we've got NFP estimated to come in at 182,000, while the unemployment rate is expected to remain unchanged at 3.8%. So if the data comes in bullish for the dollar index, so that means the actual result has to be higher than 182,000, and the unemployment rate would probably be matching 3.8% or coming in lower than 3.8%. So that sort of condition would give you a bullish. So let's just write that down, right? So that we are clear. Right. So for bullish scenario for the dollar index, so bullish, so that means DXY up, gold down, right? So for bullish set of data, that means we would need NFPs to be coming in higher than 182,000, right? And we need to see unemployment rate coming in slightly under 3.8%, right? So this would give you a very bullish set of data that is very likely to cause the dollar index to jump, and that means that's going to negatively impact gold prices. Now, similarly, for a bearish set of data, we would need to see unemployment or non-farm payrolls come in lower than 182,000 and unemployment rate to come in a little bit higher than 3.8%, so probably like 3.94%. So that's set of data is likely to function as a bearish catalyst for the dollar index, and that could then potentially drive gold prices higher. So this is how this is why it's important to interpret the data and then see whether that actually translates into the price action. It's not only important to interpret data in the correct manner, but we also have to see whether did that actually play out in the price action. So if you do get a set of data that tells us, okay, this should be bullish for the dollar index, but we don't actually see that play out in the price action, we must ask ourselves why. Right. So just be careful of that aspect as well. All right. So let's just go back to the charts. Right. So if the data for the NFPs are bullish for the dollar index, right, that means we are likely to see gold prices retreat. Now, of course, I don't know what are going to be the key support and resistance levels for gold tomorrow, but let's assume the levels don't change. So that would mean that if NFPs are positive or bullish for the dollar index, we are likely to see the first support at 1977 be taken out. And depending on how big of the move is going to be, gold prices could either find support at 1962 or perhaps even drop lower. Oh, I forgot to add that for the second support, we do have the additional supporting factor of the 23.6% Fibonacci retracement. Now, this retracement level was found by starting from this swing low here on the 6th of October, going up to the swing high here on 28th of October. Right, so that's how we got 23.6%, and it lines up very well with this overlap as well. All right, so if we do get a strong NFP number, a strong employment report overall, that's likely going to cause gold prices to tumble, right? So that means it could break through the first support in 1977 and 1962, right? Do take note, these are the support levels for today. For tomorrow, as we approach NFPs, these levels could change. Similarly, if we get a much weaker than expected employment report, that means this is going to function as a bearish catalyst for the dollar index. and this would typically act as a boost for gold prices. So we could possibly see gold prices break through this key technical resistance at 2006. And do take note, not only is 2006 a key technical level, the level at $2,000 per ounce is also a key psychological level as well. So if that level does get taken out, we could see gold prices at least push up towards 2025, 2030 at the minimum, right? If the data is very bearish, and that means dollar index is going to fall, that is quite likely we could see gold prices break 2000 quite easily and push towards 2020. All right, Wayne, so that's how you can interpret the non-farm payrolls and how it would likely impact the dollar index as well as gold prices. Right. Okay, so let's look at right, we can okay. If there's anything else you would like me to cover, do let me know because we still have a bit of time. We can cover that. Otherwise, I'll just look at dollar yen as well, right? We've had the Bank of Japan announcing their monetary policy statement on Tuesday. Then we had the Fed, and now we have the Bank of England coming up as well. So as you can see, because of the dovish monetary policy outlook by the Bank of Japan, right? That means the yen is very weak. So that means currency pairs like the dollar yen will rise. So following the Bank of Japan meeting on 31st of October, the statement and the press conference was somewhat dovish, right? And that caused this huge spike in the dollar yen. But of course, we had FOMC following up after that, where markets then inferred the FOMC statement and press conference as being bearish or dovish. So that's why you see the pullback in dollar yen play out. Right, so let's look at where some of the key levels are. Right, we do see a pretty decent overlap level here, right? Price does seem to have found support. This would previously be a pullback resistance level, right? Price running into resistance here before finally breaking higher, and as it starts to pull back, this would potentially be a pullback support level. Price does seem to be stalling around this level. Whether it's going to hold or not, it's quite difficult to tell, but this is not a very significant pullback support, right? It's not a very significant pullback support, but we can see how price has stalled around this level, right? So for now, I would identify this as an intermediate support and use a dotted line. First resistance is of course going to be the swing high that took place on 31st, right? That's definitely where the first resistance is. And if we look out a little bit, right, we can see the yen is approaching 30-year highs once again. When the yen hit 152 back in October of 2022, this was actually a 30-year high. So if we look at it on the monthly chart, right, you can see going back, this year is October of 2022, right? Going back all the way to September of 1990. So you can see yen actually hit, rather the dollar yen hit 30-year high, which is why the Bank of Japan had to intervene in the open market, right? So that's why, because of the intervention last year, that is why we saw dollar yen pull back quite sharply, right? Part of the reason for dollar yen pulling back sharply in the last quarter of 2022 was because the Bank of Japan initiated an intervention operation in the open currency markets, and that is why the dollar yen pulled back. And after that, the intervention was suspected to have ended around end of January, and that's when market forces came into play, and we saw dollar yen start to rise again. All right, okay, sure, Wayne, we'll definitely cover Dow Jones and Nasdaq as well. I'll just quickly cover dollar yen, and then we'll go to Dow Jones and Nasdaq. All right. Okay. Okay. First resistance is here. We do see pretty decent overlap here. So probably first major support would probably be here as well. You see a case of strong overlap level here. Price running the resistance, then finding support multiple times before going higher. Should this actually this is okay. Wait. This would be first support for dollar yen. This would be second support. Okay, why is that the case? right? Because we do see a very significant swing bounce here, right? You can see prices bounce off this level quite strongly. So I would identify 149 as the first support and this overlap here as the second support. All right. Okay, so let's move on over to yes, what is it? Dow Jones and Nasdaq. So on the Dow Jones, the instrument here would be US 30, right? So any other instrument that tracks the Dow Jones would be US 30 or something similar, right? Okay, so um equities have been revived following the FOMC meeting, because if the Federal Reserve is going to be neutral or somewhat dovish, that means we are likely to see bond yields pull back. So if bond yields, US government bond yields start to pull back, this is going to act as a short-term catalyst for equities as a whole. So as the bond yields pull back, value of the dollar index pulls back, you have somewhat looser financial conditions, which create a more risk-on environment. So that means equities could see a little bit of boost. So it's quite likely we're going to see equities come in or finish quite strongly this week, perhaps, right? So if you look at it on a weekly basis, right, equities have been pulling back pretty strongly since July, or since the end of July, right? But because of the hawkish or the dovish outlook or the dovish sentiment following the FOMC meeting, we are starting to see a strong bid up in equities again, right? So let's look at the 4-hour time frame and see where some of the key levels are. All right, okay, how do I set up the indicator to mark on your support? Okay, so right, okay, this is just using the ray. We use the horizontal ray to draw the lines, but because we have created templates, right? We have created templates for this in TradingView. If you just do a quick Google search on how to create templates on TradingView, you should find the information necessary. So we've done this just on our own, right? Of course, you can label it whatever you want and give it the same color code or color scheme, but these are our own in-house templates. But if you just Google for it if you just Google for it on how to set it up, you can get the information quite easily. Okay, Fibonacci. Okay, Fib when the market is bullish is 0 at the low. Okay, no, Fibonacci doesn't tell us whether the market is bullish or bearish. It just tells us where the potential resistance and support levels could be, right? So what we're looking for when we draw Fibonacci retracements, we're looking for significant swing highs like this point here and significant swing lows here. And not only that, it's also important to see or to note that the trend line here, which is this blue dotted line, captures the market structure as closely as possible. So you can see here, the market structure is captured pretty well, right? So what we're looking for when it comes to Fibonacci retracements, when it's for the downturn, you're looking for the absolute swing high going down to the swing low. And not only that, the trend line should capture the market structure quite well. Similarly, for the uptrend, what you're looking for would be the swing low here, right? This is the absolute swing low going up to the swing high here. And you can see the trend line capturing the market structure quite well again. So when you do that and you get the subsequent Fibonacci retracement levels, if I pull up all the fibs, you get the subsequent Fibonacci retracement level. So what this tells us is as price is pulling back, these retracement levels could potentially offer support, right? They could potentially function as significant support levels. That's what it means, right? So similarly, when we have this Fibonacci retracement here, we've drawn this Fibonacci retracement here, we pull up all the fibs. What this tells us as price is bouncing up, it's telling us that 23.6% could function as a resistance level, 38 another resistance level, 50 another, and so on and so forth. But as you can clearly see, in this case, 23.6% did not offer any resistance. Where it did run into a little bit of resistance would be at around the 38.2% Fibonacci retracement. Similarly, 50% offered no resistance as well. Price broke cleanly through this. And where it could perhaps run into resistance might be the 61.8%. All right. So this is how we can use Fibonacci retracements to identify potential support or resistance area. So that's why it's emphasized on potential, because you can clearly see in this movement here, 33% offered no such resistance, 50% offered no such resistance, but 38 did offer a fair amount of resistance before price finally broke higher. So do take note, Fibonacci retracement levels offer or help us to identify potential support and resistance areas. So do take note of that. All right, okay, so let's quickly look at Dow Jones and quickly see where we are. All right, first resistance here has been identified with a combination of the 61.8% Fibonacci retracement, right? This retracement level here. Right, so you see the 61% here. And not only that, this is also a pretty significant pullback level. As you can see, Dow Jones bouncing off 33,000, pretty much 33,500 here, right? So this is a pretty significant swing bounce, but on the way down, price didn't offer support the second time round. So this, what was previously acting as support could now potentially function as resistance, and it also aligns up quite well with the 61.8%, and that's why we've highlighted it as a zone. The first resistance for the Dow Jones or US 30 would lie between 33,434 and about 33,482. I do take note of that. Second resistance, let me see, this is a pretty small level. I probably wouldn't set the second resistance here because this is not a really significant level. What I would probably see would be here, probably somewhere around here, where we have an argument for a pretty decent overlap, right? We do see, right, price finding a little bit of support here on 17th of October before breaking lower. And then when price spiked higher, it did run into resistance at this level again. So I would probably set the second resistance, a real proper second resistance, at 33,830. Similarly to the downside, first support is this pullback resistance here. This was previously acting as a pullback resistance, and now it could act as a pullback support. And at this level here, you can see that, yeah, this is a pretty decent level as well. If you go back as far as here, you can argue for a case for an overlap level here. Price finding support here, bouncing higher, pulling back, finding a little bit of support, dropping, bouncing higher again, and then of course dropping all the way down to the swing low here. And then once it came back up to 33,050, it ran into resistance before going higher. So you can see what we're looking for is price action, significant price action at a particular price level or price zone to help us identify major support and resistance level. So this is what we have for Dow Jones. And if bond yields continue to slide lower, the value of the dollar index slides lower, this creates a somewhat looser financial conditions, which then create a risk-on environment for equities, and we could continue to see equities bid up, right? So this is how you can take note of why the FOMC meeting has spurred on this recent increase in risk-on activity. Now let's move on to Nasdaq. So on my instrument, I have it as a NDQ100, or we also have it as NAS 100 as well. You can also look at it as NAS 100, right? So whichever instrument you use, right? All right, most welcome, Wayne. Thank you for your kind words. Yeah, we're always here to help you out. You know, whether you're a new trader or an advanced trader or intermediate trader, we are learning something new every day, and that applies to me as well. I'm definitely learning something new every day as well, and it's all about keeping ourselves educated and engaged so that we can create the best trading opportunities for ourselves, right? That's what this is all about. All right, okay, so Nasdaq. So similarly, we all know equities rise together. So if you do see the US 30 rising, that typically means the US 500 or the S&P 500 is also rising, and also NAS 100 is going to be rising, right? The Nasdaq. So they all generally will have a very similar market structure. Generally, the DXY dropping by itself is not going to have a direct impact on equities. As I said, it's a combination of things. Equities are a bit more complex than just looking at DXY, the dollar index falling. It's a combination of um, financial conditions, equity risk premium, and also looking at the earnings of the companies as well. We're currently in the Q3 earnings season, right? So earnings are going to play a big part of where equity markets are going to drive as well. And forward guidance in the Q3 earnings is going to give a lot of traders and investors clues as to what to expect for fourth quarter earnings. So equities is much more complex than just looking at a dollar index and then saying, oh, if dollar index is falling, that means it's bullish for equities. Unfortunately, we cannot adopt or approach equities with that mindset or that framework, right? All right, Wayne. All right, yeah. If you didn't catch my name, yeah, my name is Ketan. I'll just run through the slides at the start again, just so you can see everything again, right? Yeah, I think you must have missed out on the disclaimer, so we'll run through the disclaimer before we end. All right, okay. So similarly, this is NASDAQ 100, right? I'm going to use the Fibonacci retracement. So as you can see, we start from this swing high here on 12th of October, right? Down all the way down to 26th of October. We can see that the trend line captures the market structure quite well. And if we pull up all the fibs, once again, you can see, okay, as price retraced off the swing low, you can see price did run into resistance at 23.6%. But as it approached 38.2%, it offered no resistance. Similarly, 50% offered no resistance as well. It blew through 38 and 50 with ease. Where it did run into resistance was around the 23.6%. Now, where the 61.8% is a pretty significant overlap level. Why is that the case? Because if you look here, so this previously acted as resistance, right? When prices gap lower here on Monday, this level here at 14,865 acted as pretty decent support before prices before the NASDAQ 100 move higher. And as it pulled back, it found support again on 19th of October before finally breaking lower. Similarly, as it retraced higher on 25th October, it ran into this resistance level again. So you can see what was previously a pullback support level as now would then potentially function as a pullback resistance, and with price reacting off this level, first resistance now acts as a overlap resistance, which aligns very well with the 61.8% Fibonacci retracement. So do take note, this level at 14,865 is indeed a significant resistance level based on technical levels and Fibonacci retracement. Second resistance, I would probably identify, there's no real major level that I can see in terms of price structure. I would simply just keep, although I know it's a bit far, I would probably just use the 78.6% to guide me. Although this is not a good market structure here, right? We don't see any significant resistance or overlaps. You can probably argue here there's a little bit, but it's not the cleanest market structure. But I would, for now, because there's no other level to identify, I would use the 78.6% Fibonacci retracement to help me guide for the second resistance, to help me identify the second resistance. Now, to the downside, where could we see potential support? This market structure is not very good as well. You could probably argue that this level here would probably be where price could find support, 14,430. Why is that the case? You can see price as it retraced, as it pulled back strongly, it did find support at 14,425, bounce higher. Oops. Hang on. Right, as it pulled back strongly, it bounced off this level. You can argue it did a double bottom here before bouncing higher. So you can see prices reacted off this level twice quite significantly. And then similarly, as it came back down again on 23rd of October, it found strong support here before bouncing higher and going down. So because of that, this level here could now potentially function as a pretty decent pullback support for the NAS 100. And then where the next support level would simply be the swing low that took place on 27 October. Right, there's no other real level to reference, so this is what I would identify for the NAS 100. All right, okay, so we've come to the end of today's webinar. All right, Wayne, I think you may have missed out on the beginning, so let me just quickly run through the risk warning and the disclaimer as well. Do take note that all the products on IronFX are traded on margin and carry a high level of risk. It is possible to lose all your capital. And also do take note of the disclaimer that comes with every webinar, right? The information here is not considered as investment or trading advice, but it's just educational material only, right? So my name is Ketan Ramachandra, right? So this webinar series is brought to you in a special partnership between IronFX and Everest Fortune Group, where we have been the finalists for Best FX and Equity Research for the following years, 2019, 2020, and 2021. Right, just before we end, just going to launch a poll, and if you can give me your feedback as well, we truly appreciate it as well, right? Guys, I've just launched the poll, so if you're kind enough to give your feedback, we'll truly appreciate that as well. All right, thank you very much, Wayne. Have a great trading week, and do take note of the key levels that we had described today for the various instruments, as well as the important meetings, economic events that are coming up, and how they could potentially impact the direction of markets as we end up this week. All right, take care, Wayne. Have a great week, and wish you all the best in your trading journey. And do stay tuned and sign up for all other upcoming webinars by IronFX. Next week, we've got another round of webinars coming up as well. All right. Thank you, Wayne. Take care. Have a great trading week.